Hello, everybody. It's a few minutes after 10. Sorry about those technical difficulties, but let's get this thing started. Welcome to our presentation for Coastline Capital Fund 7. My name is Andy Mirza with Coastline Capital Fund Management, and my partner Sean Irwin is on the call as well. So this is a short to the point overview of Fund 7, 20 to 25 minutes long. By the end of the presentation, you should know whether you want to take the next steps to join us or not. At the end of the presentation, we'll have a questions and answers session. Send your questions by email or use the Q&A button on the Zoom toolbar. The webinar is being recorded, so you'll be able to refer to it after we're all done. And for previous webinar attendees, a lot of this is going to be very familiar to you. Fund 7 is pretty much exactly like Fund 6, so you'll see a lot of the same information. Some things that'll be different will be an updated current and future state of the market. And then we decided that we're going to do some future webinars specifically for the subscribers of each fund. So for those of you that want to get more detail on what's going on in the fund, we're going to go do the deep dive into the details of the loans and be able to answer any of your questions in a more informal setting. That'll be open to existing subscribers only. And the first ones will be held next week. So here's our standard disclosure. It's long, so I'll summarize it. We cannot guarantee any of the results of our funds. Projections represent our best estimates. Past performance is no guarantee of future results. There are risks associated with investing in one of our funds, and you may lose some or all of your investment. Finally, this offering and solicitation is for accredited investors only. This webinar is not intended for non-accredited investors. So that's Sean and myself, Coastline Capital Fund Management. What we do is we create and manage funds that invest in defaulted mortgages, also known as non-performing notes. We're talking about home loans that have gone into default because the borrower has stopped paying. Most of what we deal with are leftover toxic loans from the financial crisis of 2008. We make money for our investors by buying notes at a discount and liquidating at higher prices. We prefer the severely delinquent loans because they have the highest returns. Think of us as fix and flip guys, except with loans instead of real estate. We buy loans that have something wrong with them. We add value by solving problems, and we exit by foreclosing, selling the REOs, or reselling improved loans. Since 2015, Sean and I have purchased $11.5 million worth of notes. We've liquidated 7.5 million of those, and that's resulted in 1.5 million in net proceeds. The average weighted return on investment for these assets was 33%. The average weighted annualized ROI per loan was 55.6%. Now I put this in here so that you can see the performance of the actual assets. Those numbers will look different than what the payouts are going to be for the investor. And I'll go over that in another slide in a minute here. Also, again, past performance is no guarantee of future results. For accredited investors who are dissatisfied with the current investment options out there, Fund 7 is a perfectly positioned distressed asset fund that provides the investor greater profit potential. Unlike bigger note funds, Fund 7 offers the investor a preferred return and a profit split. It's run by a small, nimble team of experienced professionals. So this is a 30,000-foot overview from our experience in the market. Virtually all foreclosure and eviction moratoria have been lifted in the states that we buy notes in. Restrictions affecting federally backed mortgages are ending. In general, the real estate market is warranted extremely hot, and these, in our opinion, are due to supply issues because of COVID. Fears are causing some homeowners to not list their homes for sale. Less supply. Lockdowns and moratoria are slowing the transfer of delinquent properties. So lenders can't foreclose. The courts are preventing it or are just opening back up. Cities and towns and state laws have been slowing that whole process down, but it's opening up, like I said. The lockdowns and moratoria also have affected builders' ability to build new housing because of supply of materials and labor. Also, like I said before, with some governments shut down, it's hard to get your permits. Labor, there were issues with people being sick or not being essential, part of an essential business. Materials, we saw this supply chain disruptions, prices of lumber really high. So just a lot of disruption. All of it is acting to reduce the supply of real estate. And when you have the same demand or more demand, then prices are going to go up. So these higher real estate prices are resulting in higher sales prices for our REOs. This is fantastic because we're able to liquidate things for more than we thought they would because of this thing. So even though we were delayed on foreclosing, during the delay, we actually saw the value of the underlying real estate go up, which was great for us. It's also resulted in higher bid prices at the foreclosure sales. We are selling more and liquidating more at the share of sales and being able to turn that money around quicker. It's also making short sales more viable options for borrowers of underwater loans, so that there's more room for us to work with. And we actually were able to do 2 short sales this year. And loan sellers are wanting more for their loans for sale, just for the same reasons. As far as the future is concerned, with the last of the restrictions being lifted, things will continue to move back to normal. We expect foreclosures will increase because lenders can start foreclosing again, and that will add to the supply of real estate. We expect delinquencies to increase. That's because all of the government supports are being removed right now, and so things have to get back to normal. There are going to be some borrowers that can't adjust, that they won't be able to adjust, and that will add to the supply of NPNs, which will, down the line add to the supply of real estate. We expect the real estate market to eventually cool down or flatten. And it's been so high and crazy lately, but I think as things go back to normal, we'll see the supply of real estate start coming back online. How long will this take? I don't know. I think this is going to be a longer process, and it might take some years, but stability is okay. Now, we expect our trading partners to want more for their NPNs as long as the real estate prices seem to be headed up. This does not change our strategy for finding deals, which I'll go over in a little bit too. More of the NPNs that we do buy will be farther in the foreclosure process. We really benefited from this with Fund 5 and Fund 6. So many of the loans that we bought were in late stage foreclosure or really just at the last step before going to sale. And it's really been a benefit for us. Some trading partners have seen their inventory levels drop as they've liquidated and sold. Others haven't. We have no fear that there's going to be a lack of inventory to buy. There's plenty of stuff out there for us. So the 2 biggest factors to our success are access and speed of execution. Since 2009, we've spent time and resources to develop relationships with loan traders. Through this, we get preferred access to institutional NPNs. Banks and hedge funds buy and sell loans all the time like any other asset. When they buy big pools, they keep the loans they want and sell off the rest. The people that buy from them do the same thing. Finally, the loans end up with the investors that will keep or foreclose on them. Basically, the better your access and the higher up the chain you can buy, the better deals you can get. We also have the option to pick individual loans instead of going all or nothing on pools of loans. So this is thanks to my partner, Sean, who started in the industry in 2007 and did the hard work to develop those high-level relationships. He developed those relationships by calling brokers and loan traders on Wall Street every day and making trips out to New York every few weeks. After months and months of trying and knocking on doors to hedge funds, he finally got his first loan to trade from a big bank. He found a buyer right away and closed that deal in a month. That got him in the business, and his track record of completing deals made his relationship solid. That's what gets us great deals and access to product that most investors will never see. We're small and nimble. We respond quickly. We make decisions promptly without unnecessary delays after careful consideration of what's best for the fund. Big banks and large hedge funds are slow and don't seem to be in any hurry to get things done. They're great when things go well, like having tens of thousands of performing loans, but they're terrible at dealing with borrowers when the notes go non-performing.
Guys, can you hear me?
Yeah, I can. Yeah. Hello, Sean? Okay. All right. Sorry about that. So,
Andy?
Yeah.
So you paused there. Something happened where you cut out completely just under the bullet point, banks are large and cumbersome. So do you want to go ahead and just kind of revert back to that point?
Yeah. I just got a message on my screen saying my internet connection is unstable. So go ahead and let me know if I drop out again. So big banks and large hedge funds are slow and don't seem to be in any hurry to get things done. They're great when things go well, like having tens of thousands of performing loans, but they're terrible at dealing with borrowers when the notes go non-performing. They can't seem to get things right when dealing with the hundreds of steps required for a successful foreclosure. This loan is a perfect example. We were looking at buying this and saw that the foreclosure was delayed for a year because the assignment was incorrectly prepared. By the time the bank fixed the problem and sent the right assignment to the right attorney, 1 year had passed. We ended up buying that loan. It took us 2 weeks to do the same thing that took the bank 12 months. Things are a lot different for us since we are the owners and caretakers for our investors. No one cares for an asset like an owner does. There's a sense of urgency in how we conduct our business. We don't tolerate unnecessary delays from any of our vendors. When we buy loans, there are usually issues that have stalled our progress towards resolutions. We find those issues, we fix them, and get them back on track for whatever liquidation outcome is needed. Our highest value is our ability to scour tapes of loans for sale, identify the ones that have the biggest profit potential, and to negotiate the best prices. We have our own financial model to aid us in bidding, but when it comes down to it, final selection is based on our combined knowledge and experience of our market, our sellers, and the current trends that affect our borrowers. We're always trying to get an informational advantage when making offers. If our research determines that the value of a property is significantly higher than what the bank thinks it is, we have an advantage. So I'll use an example from Fund 5. We looked at this loan. The seller valued the property at $65,000. We valued the property more accurately at $157,000. It's pretty huge difference. The seller accepted our bid at $52,000. The seller's loan to value was 80%. So he's thinking he's selling it and getting a great deal because that's a good price to sell that loan. But our loan to value is actually 33% because our value is much, much higher. That's a much better deal. On this loan, we ended up selling it at foreclosure sale for $95,000. ROI, return on investment, was almost 80%. Now, this is an extreme example. Not all the loans that we're going to get are going to end up this way, but this is real. This happened, and this is a possibility, and that's what we're striving to do with every single loan. Coastline Capital Fund 7 is a single-purpose, non-leveraged, closed-ended fund with a 3-year maximum time commitment. It offers an 8% preferred return, plus a 60 or 50% split of the profit, depending on whether you get Class A or Class B units. The minimum investment is $5,000. We lowered that from $25,000 just because it makes it a lot easier. We have some investors that are kind of in between investments, or they just want to try us out. So you know what, 5,000, it's no problem. It's available to accredited investors only. We project that the combination of the preferred return and the profit split will equate to a 15% per year return for Class A units and 13.5 for Class B units. The minimum fund size, we're looking at $1 million, and we're looking to raise 2.5 million. The fund is scheduled to close to subscribers on October 15th. Actually, that's a correction. That should be November 15th. The 2-week special offering period that I'll talk about next, that ends October 15th. We will once we close to subscribers, we'll proceed to buy one or more pools of non-performing notes. That usually takes us about 1 to 3 months. And then we'll proceed with note liquidations with the remaining time on 3 years. Based on our experience, most note liquidations take about 6 to 18 months. Once we start liquidating, we will not buy more notes. Instead, we'll keep what we need in reserve for operational expenses and upcoming renovations for REOs. But anything beyond that is going to be net proceeds that we're going to distribute in the following manner. The first set of distributions go towards subscribers' initial contribution until they get 100% of what they put in back. While their money was in their fund, it was accruing an 8% preferred return. That's what the next set of net proceeds will go to, is paying that 8% back. After that, then we go to the profit split. Profit split is 60-40, 60% to the subscribers and 40% to us for Class A, and 50-50 for Class B. Keep in mind that distributions are only upon liquidations, which means that there are going to be irregular payments of different amounts at different times. So this is not a fund that's going to give out monthly payments or quarterly payments. We set it up that way because we don't want to have any fire sales of assets just to make timely payments. But that's how our fund is different, one of the ways. We charge a 2% management fee. That's going to be based on the unpaid principal balance for the notes and the market value for the REOs. It's paid monthly once we acquire the assets. There are no other fees, and we want to have correctly aligned incentives. The bulk of our compensation comes at the end with a profit split. That's what we're trying to get to as quickly as possible. Now, we do have a new provision in the operating agreement. It allows us to suspend the preferred return and the management fees if we have any more shutdowns or things of that nature. We have not used that provision for Fund 5 or 6, and we didn't have it for 3 or 4. So here's the special 2-week offering period. The fund opened this morning, October 1st, and then for 2 weeks, we're offering unlimited oversubscription to Class A units. This means if you sign a subscription agreement to Fund 7 before October 15th, you'll be assigned Class A units. After the 2-week period, there may be Class A units available if we haven't reached 1 million. But if we exceed 1 million in the first 2 weeks, only Class B units with the 50-50 split will be available. Fund subscribers who want to maximize investments for Class A units can sign 2 subscription agreements. One for the amount that you know you can do, and another for the amount that you might be able to do. So to further explain this, we have previous investors or subscribers who want to maximize what they can put in. And so they, I tell them, hey, we might have some upcoming distributions. Do one for the amount that you can do. And if those distributions come in, then you can fulfill the second subscription agreement. Just let us know what you're intending to do. As long as we know that, it's pretty easy to either delete the investment or modify the second subscription agreement. So as we near the end of this presentation, I wanted to share a story of one of our earlier note investments. During our due diligence, I was able to piece together the background of a non-performing note backed by a nice house in Southern California. A grown-up son deeded his free and clear property to his mother in 2007. She refinanced a few months later. A month after that, $145,000 in judgments and tax liens against the son popped up on the property. This wasn't a gift. It was a plan to get it out of paying people he owed money to. The house was on the way to our old office in Chino Hill, so I stopped by one morning. Restored Chevy in the driveway, older clean RV, speedboat on the front lawn. I thought to myself, you have the money for these toys, but not for making your mortgage payment? I felt sorry for the mom, but she didn't have to support her son's choices. We got a great deal on the loan, so we went ahead with it. By the time the loan transferred to us, the borrower was about 12 months behind. She used tactics that stretched things out to 9 months before we could go to the foreclosure sale. Finally, the day before the sale, she filed Chapter 13 bankruptcy. That stalled the sale as we headed to bankruptcy court. I no longer felt sorry for the mom when I found out that she owned her own home and a vacation home in addition to this one. She sent in a loan mod request, which showed that she made $10,000 a year. How could she afford this loan on that money? Why wasn't she selling the vacation home to help pay her other debts? The bankruptcy judge believed her different stories and gave her chance after chance after chance. She made 2 payments and then stopped. After 8 months, the judge finally saw through the excuses and granted us relief. The day before the second sale, we received notice that the mom had deeded the property back to her son, and now he was filing for bankruptcy. The case went before the same judge who wasn't amused. She granted relief again, but gave the son 14 days before we could foreclose. The weekend before the sale, we got served with a civil lawsuit alleging that we were conducting an illegal foreclosure. The son's attorney requested an emergency hearing the day before our third attempt at a sale. Not every borrower acts this way, thank God. For most of our loans, we don't have to put in this much effort. But when we have to, we stay on top of things, we solve the daily problems that come up, and we don't give up. Fund 7 is one of only a few funds that offers a profit split with the investors. Most other note funds offer a preferred return, and that's it. Our investors participate in the upside with us. For the next 2 weeks, we're allowing unlimited subscriptions to the higher tier profit split units. After that, the opportunity will be gone. If you're interested and ready, subscribe to the offering by October 15th or you'll miss out. Luckily, the judge in the civil suit denied the motion to stop the foreclosure sale. Finally, we were really at the end. The sale took place the next day with the property selling at auction to an investor. The son dropped the lawsuit 2 weeks later and we never heard from him again. So the things that we learned, it ain't over till it's over. Don't be afraid of civil and bankruptcy courts. They're part of the business and you really need to learn how to deal with these and navigate them. Smaller attentive investors are far more capable of handling complicated situations than the big banks. This same situation, if it was a big bank, it would have drug out for another year or two or more than that, I guarantee it. Buying at the right price enables you to weather these occasional storms. Spreading your capital among many notes mitigates the risk even more. So today our funds are not leveraged. We spread our risk by buying lots of notes in different areas, mostly in the $70,000 to $250,000 range. Sean and I have developed a great process for making decisions. We start by asking what's best for the fund, then quickly and carefully review the different options. We listen to each other's opinions. It's easy to overlook something by yourself, not so easy when you have a partner that's going to challenge your thinking. It's another thing that gives us confidence that we're making the best decisions possible. So when it comes down to it, when you invest with Coastline Capital, you're getting Sean and me. You're getting our knowledge, attitude, connections, and grit. If you're ready to invest with us now, simply head over to our investor portal at investors.coastlinecapitalfm.com. You'll need to create a login profile. Then you can review our marketing materials and documents and subscribe to the offering online. If you want to do more due diligence before taking this step, start by exploring the resources on our website. I write a blog about the notes that we buy in detail. I write articles about our business. Reading these will give you an even better insight into our mindset and how we do business. You can also contact us by email, or you can schedule a call with me. We can dive deeper into the details of the offering until you get the understanding you need. This concludes our presentation. Thanks for joining us. And now we're going to go over to the Q&A portion. Sean is going to go ahead and answer these questions. You can send questions by email or use the Q&A window. Sean, are you on?
I am. And I believe some of these questions here are going to actually be towards you, Andy. So yeah, you might want to, there's only 2 questions that I see so far coming from Larry. Hi, Larry. And that would be basically at the end of the day, you are going to get K1s, guys, but Andy, you might want to discuss the second question.
Yeah, so let me look here. So one question says, will the fund issue composite K1s?
Right.
So I know what a K1 is, but I don't know specifically what a composite K1 is. So
that'd be a question for your legal advice on the account.
Yeah, for your CPA, or maybe you can provide more details on what a composite K1 is. But so each year, and we're on top of getting our taxes done. Usually we'll get the taxes done by the first week of March, and we send out the K1s then. So what we send out, we have the federal K1. We also send out one for the state of Delaware, because that's where the LLC is formed. And then there's a K1 that's issued from the state of Utah, because that's where the business is domiciled. That's where Sean is located, and that's where our business is located.
The second one, what type of returns? Guys, if you want to dive deeper into the fund, like Andy has said, please reach out to us via email. We can set up a call with you, and we'd love to discuss past performance and current performance with you. This is more geared towards just getting in front of you. If you guys are, it looks like Chris, you might want to have that question. So if you set up a time with us to go over that, that'd be absolutely wonderful. On the David Wells question, hello, David. Andy, you want to go ahead and take that?
Okay, let me answer. Oh, I see some other ones here. Let me answer the one again from Larry.
Okay.
Yes. Do you anticipate any distributions for funds 3 to 6 between now and October 15th? So the short answer to that is that I think we're going to do a distribution for Fund 4 and one for Fund 5 before October 15th. I'm not sure of the amount, and that can be subject to change. So, and then, to answer Chris's question a little bit more, what type of returns have you seen in the past funds? So Fund 2 is the only one that's really gone full cycle. So that one returned, I think it's 9.7% IRR to the investor. And that was over the course of 15 months. That total ROI, return was 10.2%. And that, the other funds, we can't know what the final return is going to be until we close it, until we've liquidated the last asset. There are so many factors that go into play. We don't know exactly what it's going to liquidate for, or the time period.
A good idea would be also to explain why that the note fund was a little smaller on Fund 2. But I don't think it's a bad idea. We could, if they want to know loan level of returns of what we've done within the funds, I'm perfectly okay with that. We can't give them an overall fund return rate because we don't know yet. Like you just said, it's not finished yet, so we don't know what the overall outcome is. But we just like Fund 6, we've had liquidations there already, and that's only been open with 6 months.
So we do provide the loan level detail. It's attached to the statements for the subscribers each quarter. It's also put on the website. So we do put out the information on how the loans themselves do. The ones that haven't liquidated, we don't show what our anticipated profit for that is going to be, because like I said, things change direction, and all of a sudden you think one thing's going to happen and something else happens. So I don't want to confuse people or worry people. It's part of the business. That's what happens. And then that's just how the loans do. It doesn't necessarily it doesn't directly translate to what investors get, because that payout is kind of different. So I wish I had a better answer for that. But again, once we start seeing Fund 5 and Fund 3 and Fund 5 have a really good chance of going full cycle in the next 6 months. Fund 4 also close as well, and it'll be nice when we can finally show people, okay, this is exactly what you can or what we've done in the past.
Yeah, I could also jump in just to let you know, Chris. From Fund 3 to Fund 6, liquidations have been happening and the returns have been really good. Again, Andy, I think pointed you to that. You can go to the website and see that. Again, I don't have no problems with you reaching out to me and talking to me, or I'm sure Andy would take the call too. So again, the performance now with the market the way it is, and when we purchase these and what our cost basis is to what we're going to liquidate, shows really good signs of where this fund's going to go. Don't get me wrong, not every note, like he says, goes the right directions. We've had some where we broke even. We've had some where we absolutely unimaginable returns because we got extremely lucky. But again, you combine our experience with everything else, there's no way that we'd we're going to fight for you guys as best as we can to get the returns that I know you want. I know we want. So hopefully that answers some of that. Again, you can reach out at any time. You want to jump on David Wells's?
Yeah, so David has a couple of questions. I think I answered one of them, which is about what has been your average fund return. Like I said, Fund 2 has gone full cycle. So in 6 months, we'll probably have better answers for you on some of the other funds. As far as, yes, if you invest any amount today, you will get the 60-40 split. And so how does that work when you start to pay out any returns? So as we're liquidating, say I'll take Fund 6 for an example. We were able to purchase and acquire 11 non-performing notes. So once we purchase the notes, we work actively on liquidating them. Then once they liquidate, then we look to see, well, how much do we have to hold on to for future costs and what's extra? So whatever's extra, that money goes out to the investor first. So, and that is counted against what your initial investment was. And then once everybody, so upon future liquidations, once everybody gets their initial capital back first, I mean, that's number one. There's been an 8% preferred return that's been accruing on your funds while it was active in the fund. So that's what the next round of liquidations goes to pay for, right? So every investor gets their 8% preferred return. And that's when we finally get to the profit split. And that's what gets divided up 60-40 or 50-50.
And David, you can reach out to me anytime. We can go over some, low level returns if you want, and also kind of explain, how we look at reserve amounts and things like that. How do we decide what to keep in there, what we look for. And again, our biggest thing is we like to keep the minimum amount and give the distributions back to the investors. Because again, guys, at the end of the day, by paying an 8% preferred return, it's bleeding for us, right? So our goal is to hurry up and get all your money back. That way you have no risk in the game. We get your 8% pref. Once we pay you back 100% of your initial contribution, the preferred return stops. Then we get you all your 8% back. And then Andy and I work really hard, and with all our people and our servicers and things and relationships, so that we can get the highest of profit, because that's where our families get fed, is at the end of the deal. So our goal is, again, to get you out of the risk, so that we go to open up Fund 8, Fund 9, Fund 10. You guys have as much capital that you have, and hopefully you roll back in with us. Because like I said, we see, and Andy explained it perfectly, the future market is going to be, I guess when you say when the time to flush the toilet, there's going to be a lot of stuff coming down that drain. So, and we're excited for it. So anyways.
Okay, so here is another question from a different David.
Okay.
He says the proposed reconciliation bill currently in Congress doesn't allow IRA investments for accredited investments and allows investors 2 years to get out of any current investment, as I understand it. Should this pass, have you any thought about how you might liquidate IRA investors before the 2-year deadline? So first of all, I sincerely hope that this provision gets pulled out of that reconciliation bill either way. That's my sincerest hope. And it appears that a lot of people are making some noise. So hopefully that will get done. But you're right. If it does pass, that presents a problem for people who invest with their self-directed IRAs.
So Andy, a question I think we need to find out is if they're already in the investment and this passes, are they grandfathered into that investment, and then anything starts after after the last investment?
So Sean, right now, there's no grandfather clause as it's written, from what I understand. Everybody gets affected, which is really screwed people up.
Wow. Oh my goodness.
Yeah, especially considering, so if you were in like a commercial real estate syndication where you had a 5 to 10 year hold period, it really inconveniences you. So with our stuff, really, if we had to, we could go out to the market and put everything out for sale and liquidate within like a month if we wanted to. Now, we would take a haircut for doing that, but that's,
I think we got to weigh the options.
That's a possibility.
Yeah,
I mean,
right. I think the problem with that, though, just speaking out loud, is that if you have half the people that are investing cash and half the people that are investing in the IRA, I don't want to be in a position where we're forced to do anything that's not right for the fund equally across the board. So this is
right.
This is definitely a question that needs to be addressed. And if you guys have any information on this of when this is supposed to go to the floor or to be passed or be not passed, a date would be great for us to, if you guys want to pass it. I think I'm going to reach out to our attorney and figure out what's going on with this. But again, I do not want to put a guarantee that we're going to liquidate these assets in the 2-year deadline.
Yeah,
I mean, possible? Absolutely. If the courts are open and things are foreclosing, there should be an issue, right? But again, I will not guarantee. We will not guarantee a 2-year deadline.
We can't, and unfortunately, this is a real thing that people have to consider. And I don't want to get too much into the weeds on like, okay, exactly what are we going to do if this passes? Because you can go down a long rabbit hole with that. Mm-hmm. So the better thing is you have to ask yourself the question, do you want to take the risk that this might happen, or do you not? If you're not comfortable with it, then you really need to wait until it's resolved. And we're going to launch other funds, so you can come in on another fund. So if you don't want to deal with that, I would recommend don't do it. If you're okay with taking the risk, and that's, we put those disclosures out there for a reason. You got to be comfortable with it. And if you want, you can move forward. I can tell you this, you heard enough about how Sean and I operate. If you did invest, and if this does pass, we're going to try and figure out the most fair way possible for everyone to resolve it. So that's the best answer I can give you.
No pressure, guys.
All right. I don't see any more questions coming in. If you have a question, feel free to put it in the Q&A section. We'll hold on for a little bit more for some more questions coming in.
Yeah, just give it a few minutes to see.
Yeah, again, and if you need more time to look into this, if you want to set up a call, if you want to email sometimes might be the easiest way to do it. If you got a quick question, just shoot over an email to us and we'll answer it.
Yeah, I'm actually already shooting my attorney that very question, because I'm I wasn't aware of this. This is something I was not aware of, and it's amazing what these people do. But wow. Anywho.
All right. Well, I'm not seeing any more questions come in. Again, if you have some more, feel free to reach out to us. We're available for it. thanks for being part of our webinar and for part of the Q&A. And you have a good day.
Guys, have a great weekend. You guys, if you need to speak with us, please reach out. We're here, we're ready, and like I said, it's a good time to be in our position. So have a great weekend. See you later, Andy. Bye, Andy.
See ya.